Hi there, it's been a while. I'm back now with fresh new content. I'm all moved into a new place. Maybe eventually I'll get some fun stuff for the background or I'll figure out a better setup, but I really now just want to get out some content of value. And I really do think nothing is more valuable in this moment than talking about common mistakes that new investors make a lot. And not a lot of these mistakes get even veteran investors sometimes. So I want to point a lot of these things out because I think it'll be genuinely useful information that a lot of you could use. The fact is, one of the cool things that distinguishes humans from different species is that we can learn from the mistakes of others. So I hope that through talking about incredibly common mistakes that new investors make, we can learn from other people's mistakes and we can make sure that we can avoid a lot of very common traps that happen in the stock market and other kinds of investments. So the first mistake that I see new investors especially make very often is to run out of cash. The true power of cash is that it's infinitely transformational economic power. In layman's terms, that really means that cash is liquid and you can turn it into anything else. No matter what your financial plans are, it is cash or liquid money of some form that gives you access to those financial plans and to those financial decisions. Sometimes in the rush to invest your money, you end up just completely running out of spare cash, and that's no good, honestly. And while some people may be perfectly content just dumping a lump sum of money into the stock market, you should never completely run out of cash. Think of it this way. What if you put about 100% of your available cash into stocks and all of a sudden you see an amazing opportunity that has so much potential and can probably double, triple, quadruple in value in a very short term? The thing is, at this exact moment, if you put 100% of your cash into investments, you have no flexibility and you cannot take advantage of that opportunity immediately. And depending on the kind of investment, selling and recouping your cash may take some time. You may have to sell some stocks at a loss. You may have to look on how to sell some tangible goods that you have, and you may have to look for buyers. And when it comes to financial opportunities, time is money. This opportunity may actually fade by when you have recouped enough money to invest on it. A much different story would have happened if someone just put 10% of their cash aside for new opportunities, and then when they saw this opportunity, they had at least some cash available to capitalize. Although some people may want to up that number even more. If you really think you'll be moving cash back and forth, then maybe you want to have maybe 25% at a time, if not more. Besides, please remember to have cash aside in case of emergencies. Emergencies unfortunately happen, and we want to be prepared for them no matter what their financial cost may be. Now, the second massive rookie mistake I see is essentially getting too emotionally involved in your investments. I made a video already on how to not stress when you invest, and the link will be right here. And one of the reasons we get stressed when we invest is simply because we get too emotionally involved, and it's completely unreasonable to celebrate every time an investment gains a little bit of value and cry every time it loses a little bit of value. We just have to wait, we just have to have a plan, and we just have to be concrete in our actions. One of the things that distinguishes a great investor like Warren Buffett from everyone else is the fact that he's completely analytical and not emotional at all. He bases his decisions purely on numbers, purely on research, and purely on maybe some other factors like intangible goods and management teams. He has a logical mindset when it comes to approaching his investments. And I think we could all learn a little bit from Warren Buffett, because even though we're human and we're emotional creatures, reality is that if we learn to manage our emotions while we're managing our investments, we're more likely to make sound and logical decisions. A third incredibly common mistake I see, even sometimes among veteran investors, is just not having a strategy. Ask yourself questions like, when is the point when you're selling this investment, if at all? What is the time frame on this investment? And have a concrete time frame. What kind of returns and income are you expecting to see? Are they dividend income? Maybe rental income, capital gains? There's a lot of different kinds of income. And what is the risk associated with this investment? If you can't answer any of these questions concretely, it's time to maybe take a step back and think about what the strategy you're going to use when approaching investments is going to be. I think it's more important to have a plan when going into an investment than simply winging it and maybe seeing very deep consequences because of it. Learning never stops, and maybe it's time to just take a step back, read some books, or maybe just find out about different styles of investments. For example, in the stock market, there are value and growth investors, which are two different kinds of investors in the long term. And I made another video about that, which you can check out right here. The fourth incredibly common mistake I see new investors make is simply not investigating and doing your due diligence. Your decision to invest on something has to be based on something concrete, on some evidence, on some investigations? Are there any numbers, any statistics, anything that backs up your decision to invest into something? Most types of investments have concrete numbers behind them somewhere. Companies that offer stocks have to publish financial results. Real estate markets have information on things like, for example, population growth, school districts, and more. Going into an investment blind without doing your due diligence may cost you deeply, because then you're just going to miss a lot of numbers or a lot of key factors that may actually work against you, or may actually prove that another investment is better than the one you're currently considering. Knowledge is power, and it doesn't take all that long to be informed. For a lot of stocks, for example, all you really have to do is read the annual and quarterly reports, which means you're really just going to have to read and get up to date with numbers once every single quarter. Fifth mistake that I see incredibly commonly is people forget about taxes. Say you make an amazing investment and you make $1 million all of a sudden. Well, you should not really withdraw and maybe spend those $1 million. You're going to get taxed for it, and you should pay your taxes because we want to do things transparently and legally. So if your investments have a lot of appreciation and gains, and you have maybe sold your investments or capitalized on those gains, well, be prepared to pay taxes on that, and be prepared to research on just exactly how much you're going to get taxed and at what rates, and start planning around it. Start maybe putting aside some cash to get ready for taxes. Start investigating tax laws or talking to professionals to see if there are any tax cuts you may be qualified for. There are many alternatives, but in reality, you should be prepared to pay your taxes every year. In a similar vein, people forget all the time about commissions. Maybe if you're looking for real estate and you're paying an agent, that agent's gonna have a commission when you finish buying or selling a property. Some stock trades nowadays still have commissions, even though that is sort of dying down. And even cryptocurrency transactions will have some certain fees sometimes. And you have to plan around these things. If you're investing with a tiny amount of money at a time, you're gonna have a significant percentage of your investment cut away by commissions over time. And that is something that's simply not desirable. Or you may realize you have this exact amount of money to get into this exact investment that costs exactly this much, and then you get slammed by a commission and all of a sudden you can't do what you wanted to do. Essentially, remember to read the fine print, and remember that services often charge commissions, or people who are doing a job for you expect a commission of some sort. And last but not least, the seventh mistake that I see investors make is simply focusing on irrelevant factors. Oftentimes we'll read articles or we'll focus on certain numbers that we really shouldn't be focusing on. For example, let's say a company has 5 different sources of income, and each give the company 20% of its total income. Let's say a report comes out that says one of these income sources has lost a ton of money. Should we sound the alarm button yet? Should we sell this investment? Well, the reality is there's still 4 other income sources that maybe we haven't read a report on yet, and maybe they have increased their income or maintained the total income of the company still positive, and we may want to keep this investment even though the alarm bells are being sounded about this one specific source of income. Likewise, there's many ratios or many numbers that we can tunnel vision on, and we have to think about maybe other criteria that work for or against our investment that we may not have considered before. Besides, remember that press coverage is often a person's opinion, and this may end up also reflecting irrelevant factors, since oftentimes there's more emphasis on what is shocking or what will catch your eye and make you consume a piece of media, rather than what's actually relevant and important for the investment itself. So I hope you could take something out of this video. If you're interested in investing in stocks, then I would highly recommend Webull. They're an excellent broker, and they have a promotion where you can get up to 4 free stocks if you register an account with a referral link down below. So if you're interested in investing in the stock market, you can do it commission free, and they've been a wonderful broker for me so far. With that said, if you enjoyed this video, please give it a like, and let me know, are there any other mistakes that you think people should watch for, or are there any that you've made yourself? I genuinely want to know, and I'll reply to every single comment. So please stay tuned and subscribe for more videos, because more videos will be coming soon with valuable financial advice. And I'll see you all on the next one.